Did you know that the Bank of Mum and Dad is now the 5th biggest lender in Australia? Does that mean that people with wealthy parents have an unfair advantage? And are there ways ordinary parents are helping their kids get onto the property ladder?
Today we're talking about some of the ways your parents might be able to help you get into your first home. And we have a guest expert to help us understand some of the financing options. Welcome to Your First Home Buyer Guide, the podcast for first home buyers who want to move it along and become homeowners. But most importantly, it is for home buyers who want to get it right.
I'm Megan and that was Veronica. We're both buyer's agents and probably old enough to be your mum. And that's a good thing because between us, we've got over 45 years experience to share with you and bucket loads of stories and avoidable mistakes. Together, we're going to make sure you get unbiased and real information you can rely on. Come on the journey with us. We want you to become an educated home buyer so you can stop looking for your first home and actually become a proud homeowner. We will help you get to where you want to be without missing a step or making rookie mistakes.
We've got loads of free tips for you in this episode, and if you'd like more useful tools, head over to the website homebuyeracademy.com.au. There you'll get access to our free webinar, How to Buy Your First Home with the Right Amount of Debt. You'll also find the holy grail of home buying education, Your First Home Buyer Guide, the online course for people who want to be educated home buyers. We have created this for you to help you get on the right path to home ownership for your first home and beyond.
But before we get into the interesting stuff in this week's episode, here's the boring bit, the disclaimer. You of course know that nothing in this podcast is to be taken as personal advice. We always recommend getting the advice of an expert in their field who takes the time to understand your personal situation. We've done our very best to ensure that the content is correct at the time of recording, but things change rapidly. So always check with the relevant government authority or your trusted advisors to get the most up-to-date information.
We're joined today by Jenny Fagg, who's the CEO and co-founder of To Be. And so thanks so much for coming along today, Jenny. Can we kick it off, our chat, with you telling us exactly what To Be is?
Lovely. And thank you so much for inviting me along, Veronica and Megan. I can talk all day about Bank of Mum and Dad and first home buyers and bring it on. We love it. Thrilled to be here. So To Be is a specialty lender. We are set up to help people over 55 to access the equity in their own home. So I am a baby boomer. I'm the last year of the baby boomers. So someone like me, if I've paid off my mortgage, own my home outright, but I can't necessarily prove to a bank that I can service the debt. So I don't have enough income to prove that I can make the repayments over the next 10 or 20 years. The alternative for me is to draw down on the equity I've built up in my own home, take out a loan against that, and, for example, give it to my daughter as a deposit to buy her first home. And the advantage with that is that parents can help the kids get on the housing ladder when they need it. Another fact, I'll just keep going for a minute.
Please do, because we've spoken to you and Veronica and I are both so excited about this option as a consideration for people.
Great, thanks. Yeah, so to your question, is it only the really wealthy who can get help from Bank of Mum and Dad? No. And you'd be aware about 60% of first home buyers now do get help from mum and dad. And we're set up to try to help people. I mean, clearly the parents, so, you know, the over 55s have paid off their house. So they do have wealth. They have amassed wealth in their own home, but they don't necessarily have the income in terms of cash flow. So yes, our passion is helping people free up that wealth from tied up in their house, but to help family, they could actually use it to buy a RV or to buy an investment property as well. But my real interest is the first home buyers, so the bank of mum and dad.
So I guess we always talk about, obviously for first home buyers, your first property is the first step, the first rung on that ladder, right? So I guess what we're talking about, two ends of that at the moment. We're almost talking about almost the last rung, or maybe the second last rung, and the first rung. So we're talking about the parents.
That's a good way of putting it.
Yeah, so the parents who might be teetering on the top of that ladder, who don't have the cash flow and don't necessarily have the income. Maybe they're retired, maybe they're looking at slowing down, maybe they're moving into retirement, but they might want to access some money for all sorts of reasons. As you've said, they might buy a boat. God, it's not a good investment, people, but
that is a lifestyle.
That's it. That's a lifestyle decision. Or it could be that they do want to help their kids get on the ladder, because that is something that is increasingly bothering people who already own property. They're thinking, oh, it's good for me. Baby boomers, I've been able to benefit from all the rising prices over the decades. And my kids don't have the same opportunities that I had. So there's a lot of people that are thinking, how can I help my grown-up kids? And there's also a lot of kids. When I say kids, I mean, you're obviously adults, but you're somebody's kid. Who are thinking, how can I get my parents to help me? Because it is bloody hard, So you should.
There's genuine desire to do that from a lot of people, to say, how can I help the kids do this in this really difficult environment?
And you might want to share this episode with your parents if this is, if this applies to you, by the way. But so just to sum that up, though, if somebody's parents want to help them buy their first home, but they don't have the spare cash to give them or to lend them, they can tap into the value of their own home as long as they own it outright. Have I got that right?
That's correct, Veronica. It's their own home, or some of the parents. So some of our borrowers are lending against investment properties or a holiday. So as they have a property that's worth more than $750,000 that they've paid off or have fully paid off. So they, most of the equity is owned outright in one of those properties, then the parents can take a loan out against that owner-occupier investment or holiday home. They would then give the kids, as you said, the child, typically in their 30s, they'd be able to give the kid the money for a deposit to buy the home. So they're quite separate loans. We don't try to conflate the kids and the parents. The child should still get the best standard mortgage they can. But with the parents' help, they can get the deposit, not just to get into the house, but to get into the house that they want. I know you guys talk about, you need to look down the track. You want to invest in a place that will be right for you in a 3 to 5 years' time, not just trying to, kind of buy a place for short term and then incur the stamp duty and the other cost each time you trade up. So with the parents' help, we can build the family balance sheet, because the parents keep their house, kids get into a property that they want. Then after, 3 to 5 years, the family's just so much better off because there's 2 properties in the family's household.
That's so good, because the other options sometimes are using the parents' house as the equity, which cross collateralizes and kind of ties those properties up together. And it means that if one wants to do something, it has an impact on another. Whereas what you're talking about is 2 very separate borrowing events. One that is the parents as a borrower, and one very, very separate event, which is the kids, the offspring, who are doing the borrowing on their own merits, but they are using some of that money from mum. It's sort of like, and this is, in talking to you, it's sort of like potentially bringing some of the inheritance forward, that the parents get to share that before they depart, rather than waiting until, and see the use of that money. It kind of feels like that to me.
Hold on, Megan. It's exactly how some of our clients talk about it, bringing forward the inheritance. So I've just got a few numbers that I can throw at you. The average first home buyer age is 36, according to our research. I know going up, it could mid-30s, let's go with. Most people only inherit, get their inheritance when they're over 55, of course, because people are living longer. So the time that kids need help with their first home is about 20 years out of whack. So what we're trying to do is finding out a way how can we help the families by bringing forward the inheritance so that the kids can get the money when they need it to get on the ladder. But also, as we talked about earlier, the family overall is better off because they've got more properties that are appreciating.
The family would be better off just for the fact that kids aren't waiting for the parents to die too. I'm sure that's actually a good thing for family dynamics. Who I guess
This will end up being on a murder investigation podcast or something.
aha, the motive. They wanted a home.
They were
Now,
to get into the rising house prices. They couldn't get the deposit. No.
we are dealing with borrowing money here, though. So, and I would imagine a lot of parents are going, hang on a minute. I paid my house off. I've worked hard. Even though I want to help my kids, I don't necessarily want to go into debt again. So, and obviously the money has to be repaid. So I'm curious as to, a number of questions. One is, I guess, is the money lent at market rate? So is it lent at the same sort of rates that you'd be paying for your mortgage? And also, what are the repayment options? Because if it's like, and we haven't used this term before, but reverse mortgage, which is, you might even want to explain what a reverse mortgage is. If it's like a reverse mortgage, that's like money that's borrowed against your home and you don't pay back until you sell the home, right? But then there's an accrual, there's an interest bill that's going up the longer you have that property versus, okay, well, I'm going to refinance the new home and pay it down, or what time frame is involved. So I'm imagining there's a lot of these sort of questions to be floating through the minds of the parents. The kids may not. They might be just looking at the dollar signs of the deposit, but then they go, hang on a minute, I do still have to pay it back. So instead of saving it up, I'm paying it back. What are some of the approaches to that? And back to that, is the money lent at market rates too?
Rate. So let's start with is the money lent at market rate? If parent can afford a standard mortgage, they should take a standard mortgage. So the product we offer is based on the reverse mortgage regulation. It's not a traditional reverse mortgage, but we do use that regulation. And what that means is that the parents can decide to pay interest each month. So if they want to, they can make the repayment. But if they choose not to, then the capital interest does capitalize, to your point. So you could take out $100,000 on day one. At the end of 5 years, depending if you've made payments or not, you could end up owing like $135,000. I'm making that up, but it's it can capitalize. So the real benefit of that, of course, is it gives people the option. If they have the cash, they should pay the income. They should pay the interest each month. And we actually give people a 25 basis point discount if they do pay the interest each month. But if they're not in the financial situation that month to make the payment, then the interest will capitalize.
So they don't have to choose up front.
No.
Okay. Oh, that's interesting.
Yeah, they can do it as they go. But the beauty of that is it brings forward lifestyle choice, but people do have to be aware of compounding interest. So just like compounding interest is good if you've got a deposit, if you're saving money, it helps. You get interest on interest. With a loan, you do get charged interest on interest, as you know. So over the years, if you don't make the interest-only payments each month, the amount that you owe to 2B does go up. So that's why it is a higher rate, because it's a specialist product that offers flexibility other products don't. And which is why I say if you can afford a standard mortgage, it's going to be at a lower rate than our type of product. So 2B Equity Advantage is currently 8.4%.
Okay. Right. So is it possible then that a parent and child may negotiate that the child pays the interest just as they would their other mortgage interest on the separate loan? Is that a possibility they may negotiate as part of their terms with each other?
Yeah, perfect. Although the way we've structured it, and this comes back to how do parents repay the money, which is your other question, Veronica. Yes. So in the case of a Bank of Mum and Dad loan, the child would could pay the direct debit. So we can set up a direct debit, and then the child can pay the money to the parent. We would take the money from the parent's account.
Okay, so it has to be paid by the parent's account.
On the parent's account. But on our website, we do have, for example, the free legal templates for a loan arrangement between the child and the parent. Do encourage kids to set up the direct debit with their parent so that each month, everyone knows what's going on, if the money's coming in or not. The other thing then is how do the parents pay it back? At the end of the modelling we've done shows it's around 3.5 years, but, depends on the interest rates, on how much the market's going up or in value. But typically the child, mid-30s child, should be able to refinance a loan and pay back their parents within about 3.5 years. So you take out a loan with, say, ANZ, the child, to 80%, get Bank of Mum and Dad to give the extra. So they've got 5% saved to get Mum and Dad to put the 15% in. So start again. Standard mortgage at ANZ, 80% with the child. Child has 5% deposit saved. To be loan or would put in the 15% for the deposit. And then at the end of 3.5 years, the property should have appreciated enough in value, and there should have been enough repayments from the child into their standard ANZ type loan that they can refinance with ANZ and pay back Mum and Dad.
So
that
this
was
is
a very lengthy explanation.
Veronica, I'm hearing asset selection being...
That's exactly what I'm thinking. Because, and anyone who's listened to this podcast will know that not all properties go up in value, and not all properties go up in value at the greater rate versus others, equally. And so that's where it's so important that, I would think if I'm a parent that's going to lend my adult child, money by drawing down the equity on a home that I've paid off, then I want to be pretty certain that they know how to choose a good asset. And they're also, there's a number of things. I want to be pretty certain that their relationship's pretty solid. I want to be certain that they've got good employment, that they're actually going to, that they're good on their word, they're going to pay down the debt. I like the fact that you've got templates, agreement templates on your website, and we're going to put the link in the website too, in the show notes to your website, because there's heaps of resources there for first home buyers, considering using the Bank of Mum and Dad. And also for the Bank of Mum and Dad themselves to be thinking, what the hell are we doing here? This is a very interesting time, because it's like they're risking something that they've worked hard for, and the kids obviously, we just want to get on the property ladder, particularly if prices are rising. Now I can see that the application for this would work really well. So the typical sort of candidate for this sort of lending option would be somebody who's got adult children who are in a career that perhaps they're in their early years of, and they can really see that their incomes are going to substantially increase as they acquire skills and climb their corporate ladder. Potentially also a couple that might have young children that are still in those fairly early years and they haven't yet started school, and they're thinking, well, one partner is home helping, rear those kids, and they're going to re-enter the workforce maybe in 2 or 3 years. You could see that. You could see also, but careful asset selection in terms of, choosing a property that we're really confident is going to grow in value. So all these sort of things will almost have to, the arrows almost have to point in all the same directions to make this a viable option for people. But also, as if you're in a situation where prices are rapidly rising and you can't outsave the market, if you put all the inputs in and then you're in a situation where you think, what, in 3 to 5 years I could repay that is a hell of a lot quicker than trying to save up the additional 15% deposit while prices are rising as well. And also there's a savings at LMI too, I would imagine, too.
That's right. Savings of LMI as well as a better interest rate. So...
because you've got a higher LVR, a higher loan to value ratio. Yes. Okay.
On the and thanks for mentioning the tools on the website. We have I think it's called the children's calculator. So
I love that. I've played with that a couple of times, actually. I love it
it's
for a
great.
number of reasons.
So what did you like about it, Meg?
I liked. Okay, so what I liked was when you get in, you can put in some different scenarios, but it shows you the opportunity cost of not getting into the market. So and I won't describe because I'm not going to do it justice. Just get in and have a play with it. But it's a beautiful way of looking at compounding growth and the impact that has on getting into the market at a certain point in time versus another point in time. And that's, we talk about, bang on about that, Veronica, and that is, you can get into the market in 5 years' time, but how much has the market risen in that amount of time? And what are the other options that you could have taken that could have got you into the market earlier? And obviously, I'm big on risk management. So we're going to talk about risks shortly. But, that I love that calculator because you can actually see it's very visual around the opportunity cost of not doing it. Well done on that, because that wouldn't have been easy to create.
No, it it is such a complex area, as you know, and to make it simple, getting the data is not the hard bit, but how to make it understandable. I should say the opportunity cost, wait the 7 or 8 years to buy, but by then the house you buy, say it's worth 750,000 now, by the time you've saved 750,000 in 5 years' time, that house would only be the equivalent of what's worth 500,000 now. Those numbers are made up.
It's very clear.
Yep.
It's really, really clear. And I love it for that, because I don't think, we talk about it, Veronica, but I don't think we've been able to demonstrate it as clearly as that calculator does.
I confess, I haven't played with it, and I'm going to
Oh
go.
my God, do
I
yourself
can't
a
wait
favour.
to. I can't wait to. I'm getting on there right as soon as we hang up. I'm getting on there.
We're going to be talking to Jenny about how we can use that a little bit more, I think, because it's a cracker. I really like it.
Because it is exactly right. Trying to sort of go, but I'm paying 8% interest, and even if it does accrue, like, that's $35,000, and will the property have gone up more than $35,000? Well, if you have a good asset selection, yes, it will have. So it is. It's like we can easily focus on the wrong numbers, but the big picture is, at what point, are you ready, and do you need the home, and could you afford the mortgage, and all that sort of palaver? And if this does help you get into the market sooner, or into a better property, like you alluded to earlier, if you can get into a property now that you won't have to upgrade in 5 years, you can actually stay in it for 10, because you are able to get the bigger home now and save all that. That's another use case, if you want to call it a use case, for this, because, that's so often the case that we just scrambled our first rung on the ladder is very close to the ground, and the gap between it and the next rung we can't quite reach. So if this allows us to actually bridge that gap, then that's something well worth looking at.
And a better quality asset.
And yes,
a better quality asset, because that is, at the end of the day, getting that first one right is the ladder. Everything else is just a stone that kind of gets you, to the first rung, and probably even, if you got the wrong shoes on, you're going to fall off. Don't take your heels to climb a ladder. But
I have climbed a ladder in heels before, by the way.
I absolutely have to. And I
Not
was
a good
heavily
idea.
pregnant when I last renovated my last house. Sorry, Judy, this is what we do. Feel free to join in. I was heavily pregnant, going up and down a ladder for a renovation with my first child, and I look back now and just think, oh God, where was your risk management then, Megan?
I wouldn't have done that.
Digress. Let's segue into risk. Jenny, there is some risk here. Okay, so let's really lay it out on the table. What are the risks to the parents? What are the risks to the children? And what conversations do they need to sit down and have together to start thinking about, okay, what if?
Yes. Perfect. And it is all about the conversation and discussion and common understanding as much as anything. So, in fact, I got into this by building a risk education tool to help parents understand the risks of lending to their kids.
Oh, really?
Oh, really?
I
tell us more.
So my PhD is in credit risk. So I took some of those fundamentals and turned them into a like an education for parents. So 6 tips, if I'll just go through them quickly. But the key ones, as you say, just like talk about it. So the main thing is to preserve family relationships as well as the balance sheet.
I love that that's the first one.
So the first one has to be, talk about it, talk about it, talk about it. Couple of key things to look out for, though, in terms of the family relationships. One is what happens with the other siblings. So you mentioned,
Yeah, we haven't talked about them, have we?
yeah, that's right. A parental guarantee can work if there is one child. So, you don't have flexibility, but you could do something like that. More than one child, what do you do with child number 2 or 3? What do you do if one child is on a high earning role and the other child is, not as affluent? Do you disproportionately reward one? There's lots of ways to structure that, but
great questions.
you have to think about that as a parent before you give the first loan to the first child. But that's the first. How do we have the conversations and understand the risks? Second tip we give is the parent understanding how much they can afford. So it sounds silly, maybe, but, as you say, these people spend 15, 25 years paying their home off. To take out another loan is risky. It is. So it's it's the benefit of helping your family, of being generous, of building the balance sheet. Can you afford it? And not just can you afford it, but if you give one child $200,000 now, in 5 years' time, can you still, if the kid can't pay you back, can you get by without that 200,000 if something goes wrong and the child cannot pay you back? So the parents need to work out their affordability on the basis that what if it goes wrong? That's how you have to look at it. So second tip is parents' affordability. Third tip, kids' affordability, which, as you've mentioned, consider can your child pay back the money? And if they can't, you're not really helping things by getting them into debt that they can't service down the track. That's the third tip. Fourth tip, big one is documentation. And I don't know if you've covered this separately in your sessions, but is it a gift or a loan? So
No, we haven't. Well, we actually have. We did. I remember that interview with Barry Freight about the agreements that need to. He's a lawyer, but the agreements need to be in place. We did talk about, even taking, like, basically becoming the mortgagee or the mortgagor. I always get confused which was which. But we'll put the link to the show in the show notes. So that episode.
I'm going to watch
well,
that one again.
Yeah, that's all about agreements and the legal side of this stuff and the actually what is it? Yeah.
But I like that, Jenny. That's a really great tip.
So if it's a loan, there's asset protection. So, for example, there's
For the parents.
For the parent, not for the child, actually. I'll give you an example. It helps the parent, but I'll give you an example. So it's called the hairy biker example. I borrowed the example. So my daughter, who is in a relationship with a lovely young man who is not a hairy biker, just to be clear, but if one's daughter is married or in a relationship and they, buy the house together, if I was to give my daughter the deposit, say $200,000, if in a year's time my fictional daughter and the fictional hairy biker split up, the hairy biker gets half the deposit effectively. So put my money in, but because it's a cohabitation and they've taken out a loan together, if they have to, divide the assets effectively, the boyfriend or girlfriend of my child gets to keep half the money I put in. That's if it's a gift.
It's a gift. Okay.
Whereas if you set it up as a loan, the money needs to be repaid to you before the proceeds of the asset.
So you're a creditor.
Yes. So you've protected the assets for your child as well as for the family.
Jenny, I know you're not going to give advice here, and that's absolutely not your role in this. It's just to, enlighten and inform people about what's an option. But can you give us, the loan versus the gift, give us a little bit more around that.
Sure. And I hate to think how many times you've said that. So thank you, Megan. We're not here to give you personal financial advice. So appreciating you saying. Um, as a generalization, I would say a loan is a much more sensible structure because it does have the asset protection built in. But it also forces the discussion and the conversation. So if it's a gift, it's easy to sort of say, here's the 30 grand, the 200 grand, whatever. Maybe pay it back when you sell the house. And that's what the arrangement is. That very few of these arrangements are documented. Whereas if you do it as a loan, if it's set up as a loan, it can be an interest-free loan. So the child doesn't even have to pay interest, but at least it's documented that they owe you the money that you've given them needs to be returned. And we'd recommend that's done. Perhaps the wording there is if the owner's change on the title. So addition can be if there's any change of the borrowers or the title, then the money that's been lent by the parents needs to be paid back first.
Good discussion point to have with your solicitor.
Yes.
Great discussion point for a solicitor. Yeah, fabulous.
And we do have the templates on the site, but once again, you need to talk about. I know one of your tips is talk to the right people. So talk to the professionals on this one.
Yeah, and this is a thing too, isn't it? Because, you want to be helpful and no one wants to have these icky, sticky discussions. But, oh, my God, if you don't have the icky, sticky discussion and all the shit hits the fan, basically you're going to wish you had the icky, sticky discussion.
Jenny, if it was set up as a loan, is it possible that might affect the child's borrowing capacity from the bank that they're going to?
Great question. Yes, and depends how it is set up. And it depends on the bank. So the first thing is make sure you ask the bank or the broker, whoever you're dealing with, if there will be an impact. So being transparent with the bank and the broker is really important. And why I say it depends, banks' policies vary a little, but it also depends how the loan is set up. So if the loan, once again, not personal financial advice, but if the loan is set up with a 0 interest rate, so that means the money needs to be repaid at some stage, the principal
but not
amount.
and as a monthly repayment.
But there's no monthly repayment required from the child necessarily. So it's set up, you kind of have an agreement. The money needs to be repaid if something happens and the names on the title change or the borrowers change. So if the kid's circumstances change, the loan needs to be repaid. But if it's set up in a way that monthly payments are optional.
Optional. Okay.
Optional monthly payments, then it should not affect the child's serviceability. So once again, talk to the bank or the broker.
Right.
Brilliant. Where are you up to on your list of risks there, Jenny? Because you were working through them.
Yes. So we started with the icky, sticky discussion. Went on to parents making sure they know what they can afford. So that was number 2. Number 3 was the kids' affordability and ability to service a loan. Number 4 was to gift or loan, which we talked about. The 5th one is making sure parents are aware of the funding options, which is what we're talking about now. In fact, some statistics here. We did research that showed that nearly 2/3 of parents would say they would like to help their kids buy a home. So nearly 2/3 want to help the kids with a home. About 44% of parents agreed that they would help their kids by drawing on their home equity, which is an astonishingly high number. But many of the parents we've spoken to haven't realised that this type of product is available as an option. So the point for parents is find out what your options are. Don't assume because you don't have an income you can't lend, would be the 5th tip. And actually, just if I could add a little point there, whilst the majority of parents said they'd like to help their kids, kids were often reluctant to ask for help. So this was a surprise too. Got about half of 18 to 34-year-olds disagreed with the idea of asking their parents for help. So you've got parents wanting to help. We've got kids not, probably wanting to go it alone, be independent, pride, awkwardness. So a tip there is kids actually ask your parents. They may be a lot more willing than, and just not knowledgeable about what's available.
Oh, that is such a good point.
Although I'm going to be the devil's advocate here. If your parents are control freaks, you know,
Oh, there's a lot of it to.
and they don't let you live your life the way you want to live your life, don't ask them for any money.
You know, no such thing as a free lunch, is there?
Yes. And that's true. There is then a change in the relationship, particularly if there's a lending agreement in place, as opposed to a to a gift. Wow. Yeah. Well, you know, I would be really interested.
Hang on. Before you ask that question, is that the end of your list there, Jenny?
This is the world's longest 6 tip.
Yeah, I know. Otherwise, I thought we'd just get there. Then hold that question, Megan.
The 6th tip is just to document everything. So yes, the 6th tip is preserve family relationships, parents' affordability, kids' affordability, gift or loan, funding options for parents. And once you've worked it out, document everything, because it can help some of that icky, sticky situational awkwardness. Of course, when things go wrong, that's exactly the time you don't want to be having,
Misunderstandings. Oh, but I thought you meant this. No, I meant that. I didn't think you wanted me to pay it back. Oh, yes, I did.
And then the younger brother pops up and goes, "What about me?"
And when I was 3, you gave her a big cake, and you gave me.
I've heard conversations exactly like that. But what if something unforeseen happens to the parents and the parents have to sell? What if the parents get divorced?
Great question. Needs to be documented. That is definitely not a one size fit all. What happens if the parents? It's what happens if the parents split up? But it's also sometimes if both sets of parents want to put some money in to help the kids, it can get.
That gets really complex, doesn't it?
My my parents are putting in 7.5%, yours are putting in 7.5%, or mine is putting in 5, yours are putting in 10. Another option, another layer of complexity.
Which doesn't mean that it's not possible, but Jenny, I think if people really take notice of your 6 tips there, then it is actually possible to do some of those complex things. But I'd be really keen, Jenny, do you have anything on your website that is almost like conversation starters? So like some tips or a download that can start, how to start the conversation and the types of things that you need to talk about. And don't forget to think about, have you got a little bit of a roadmap or I'm not a cheat sheet because I don't want to cheat on anything here, but like a guide on how to start these conversations?
Yes, thank you. And I enjoy a cheat sheet myself. I think they're very sensible.
Love a good checklist.
Checklist, yeah. The checklist is probably kinder. Yes, so on the website it's called BOMAD, and there's a tab called BOMAD, and it's got setting up the bank of mum and dad for success, and it goes through each of those world's longest explanation of 6 tips on the site. Also, if people request it, there is a PDF that we can send out if they prefer us to send them something as a single document.
They can leave just casually on the dining room table when they go to visit their parents next time.
Not so underhanded, but it is a hard, as you say, kids are less likely to ask. Yet parents are quite open to doing it if they understand, and having a conversation starter around it. It may well be, I know with my parents, one parent is he just does not have a lot of care about risk. He just wants to get in and help them. And mum's really quite good at going, well, hang on, no, we need to really think about this and have, and that's, usually people who are risk averse, married people who are risk high in risk management. So, that's what makes them survive and not actually end up spending every cent that they've got. But I think it's good that there is a tool there, and you might sit down as a family and say, I like the idea, but this is not for us. But I'm glad that we had the conversation.
Yes. And yeah, no, absolutely. And to your point, I think generally it can be worked through. It's more that people aren't aware that they need to work it through. So by having that knowledge that there's lots of things to think through, fill out the forms. We've got forms on there. Just once again, a conversation guide. Actually, I think we call it a conversation guide. Yeah.
And this, this is something that, like you said, it might not turn out to be for them or for you as you're listening to this, but I think exploring it is certainly well worthwhile, particularly if those stats, apply to your family where you're thinking, I don't want to ask, but your parents would be quite open to it if they knew that there was a way that they could do it. And financially it worked for everybody. You can all afford it and run through those 6 tips. So that's a really, I think, an interesting option that we want to sort of start doing more of these episodes where we do look at other options at getting into the property market, because as we're all aware, it's not getting any easier. And so is there anything before we wrap it up, Jenny, that you'd want to add? Because I want to make sure that anybody who's listening to this that thinks, look, this could be a good option for us, I want you to share it with your parents. Is there anything that you'd want to add as a sort of final parting word, Jenny? Oh, and Megan has a final question for you anyway, so don't think this is the last question. It's the second last question.
Okay, if you're feeling very cheeky as a child, you could go onto the website. So it's 2b, digit numeral 2be.com.au. Go on, it's called the Financial Firepower Calculator. Megan's already done this, I know. What you can do is you put your parents' address into the search engine. The site will bring you up the value of the parents' house. So you just put in their address, you get the property report. We get it from CoreLogic and Ilion, by the way, are our providers.
An estimate. Yep.
Yep, the estimate, that's right. And then if you know your parents' age, and they're over 55, you put in the age of the youngest parent, and that will tell you how much your parents could actually free up of the equity in their own home, if, assuming they don't have a loan. That's what I would leave on the dining room table, the firepower calculation saying, Mum and Dad, you can free up, $1.5 million if you wanted to.
Wow.
That's really getting them between the eyes, isn't it? May I suggest a gentler approach?
Leaving the piece of paper lying on the table, maybe.
Hey, Mum, Dad, found this awesome possibility.
Yeah. One thing I would caution there, I'm guessing that if they did go through the application process, there would be a valuation required, and the numbers might change a bit.
Well, yeah, good point. So we use a digital valuation. If it's within a tight confidence interval, so if we're fairly confident based on the valuation that it's likely to be accurate, we actually just do a digital valuation. We don't even do a full valuation.
I guess that works because it's like,
yeah, you're lending a small proportion of the value, right? So it'd be different if it was the actual the property you're purchasing. So what is the maximum proportion of the value that you would offer access to under this program?
Great. And I should have mentioned that, so thank you. It is 15% to 35%, a loan to valuation ratio, depending on age. So
Got it.
If parent is 55, then the maximum loan to valuation ratio is 15%. If the parent, and then it goes up 1% per year until age 75, and then the maximum loan to valuation ratio is 35%.
I must ask, why is it that way around rather than the other way around? Why isn't it more the younger you are, less the older you are?
Yeah, it's interesting, isn't it? It's because it's the impact of capitalizing interest. As you get older, you live longer, basically. So when you're 55, you have
a longer time to live.
Longer time to live, better time to live, great time to help your kids. But yes, over time, if you don't pay interest, that the capitalizing amount does grow. So as you get older, there's just less time for the capitalising interest to grow.
So sort of minimising the risk in that regard of it blowing out to being worth more than the property's worth. I guess the actuaries have got their hands on that and sorted that one out for you, right? Yeah.
In fact, ASIC. So we are regulated by ASIC. So all of our lending is done under strict lending guidelines. So yes.
So that's the reverse mortgage regulations, is it?
That's correct. So
got it. Okay.
That's what I say. We do feed off loss, but not a traditional reverse mortgage. We do work off the reverse mortgage regulation.
Yeah. Okay.
Yes.
Jenny, we obviously talk to first home buyers, and we always ask our guests, what is one thing that you know now that you wish you knew when you're a first home buyer?
Can I give you two parts to that answer? As a very first home buyer, I overextended myself, and did not allow, and I was a single person, I did not allow enough money for the stamp duty, even the cost of the removalist, getting the utilities put on. I got that wrong. So as a first home buyer, my asset selection wasn't bad. It was a horrible little unit, but it got me on the ladder. So that was good. But I actually overextended myself. I hadn't understood the sheer cost of purchasing. The second learning was probably as a second home buyer. I did the opposite, which is actually, say I was in a marriage or relationship. There was two incomes. We were very conservative when we worked out how much we could afford with a house. In retrospect, to your, to the key point on which you guys talk about, we should have actually extended ourselves a bit further, got a better property. We wouldn't have had to trade up as fast and have all those costs of trading in and out. But it was luckily we did have a good location, so we could actually trade up pretty easily, but it is expensive.
Yeah. Two really good points, actually, because it's a fine line between overextending and underextending, isn't it? Jenny, thank you so much for your time. It's a great discussion. It's such an interesting solution that will be appropriate for some people, and we want to sort of keep bringing some of these to the audience. So thank you again for your time, and we look forward to, I guess, keeping in touch, because you've got lots of interesting things on your website. I'm going to go out there and have a play right now.
Have a play with a calculator. In this episode, we've only touched on a tiny part of the huge amount of things you need to know to become an educated first home buyer. There is so much more for you to do. You can learn all of the steps in the right order and avoid all of the mistakes that others have made in our 10-step online course for first home buyers.
If you'd like to learn more about the right process and avoid making rookie errors, become an educated home buyer. Head over to the website, check out your first home buyer guide, the course that we have created for you. And don't forget to subscribe to the podcast so you won't miss an episode. And if you've liked what you've heard today, please give us an iTunes review. It helps other people find us. And of course, I know it's a bit cringy, but we're going to ask for 5 stars. Thank you.
Thanks for joining us. We hope you've found this really useful. And if you have, please share the love with others who you know are in the same boat. We'll be back next week with more priceless stuff.